Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business, what it does, how it makes money, and what makes it competitively distinct.
Clorox was founded in Oakland in 1913 as an industrial bleach operation. Over a century later, the company still holds the #1 bleach position in the United States, a remarkable brand durability in consumer staples.
The portfolio today spans 4 segments. Health and wellness covers Clorox bleach and Pine Sol. Household manages Glad bags and cat litter. Lifestyle holds Burt's Bees and Brita water filtration.
The cleaning category dominance is the central moat. Clorox doesn't own just one brand. It simultaneously leads across bleach, multi-surface cleaners, drain openers, and disinfecting wipes across different retail aisles.
Burt's Bees gives Clorox a foothold in natural personal care, a faster-growing channel that reaches a younger demographic and operates globally in over 50 countries, well beyond the core U.S. cleaning business.
On unit economics, gross margins around 42% reflect genuine brand pricing power. Clorox regularly takes price increases, and consumers largely absorb them because brand trust makes private label substitution psychologically uncomfortable.
The peer set includes Procter & Gamble, Colgate, and Church & Dwight. Procter has greater scale and margin advantage, but Clorox's concentration in cleaning categories creates depth of category expertise that larger conglomerates lack.
Linda Rendell became CEO in 2020. Her tenure has navigated a challenging stretch. A major cyber attack disrupted operations in 2019, followed by a pandemic-era demand surge, and then a painful post-pandemic normalization period.
The dividend record is exceptional. Clorox has raised its payout for over 47 consecutive years, qualifying as a dividend aristocrat. The current yield, around 3.2%, appeals to income-focused long-term investors.
International revenue is roughly 17% of total sales. Markets in Latin America and Australia contribute meaningful volume, even as the North American home market remains the primary earnings driver for the company.
Ongoing brand investment, around 10% of revenue, is critical to maintaining top-of-mind awareness and defending shelf position against the persistent private label competition that pressures every consumer staples company.
Clorox products sit in a genuinely non-discretionary category. Consumers buy bleach, trash bags, and disinfecting wipes regardless of economic conditions, providing the kind of recession-resilient demand that defines the consumer staples sector.
The Glad business, plastic bags, wraps, and containers, occupies the household segment and commands a significant share of the U.S. market, adding another category-leading position to an already concentrated brand portfolio.
Products reaching over 100 countries confirm that Clorox has built genuine international relevance across both its cleaning and natural personal care platforms, extending well beyond its American origins in industrial bleach.
The long-term thesis for Clorox rests on brand durability, pricing power in non-discretionary categories, and a dividend growth track record that rewards patient shareholders through economic cycles and operational disruptions alike.
That's the company chapter for Clorox. Now that we've got the full picture, let's get into the earnings.
Time to get into the numbers. Let's go.
Picture this. Your company gets hit by a cyber attack so devastating that it cannot process orders for weeks. Retailers run out of your products. Revenue collapses. You spend over $350 million recovering. Fiscal year 2024 becomes a write-off. Fiscal 2025 is triage. And then in Q1 2026, you report $1.64 in earnings per share against a consensus estimate of $1.55. A 6% beat, and revenue of $1,669 million. That is the Clorox story. This is a company that was genuinely broken 28 months ago, and the earnings results coming out today suggest it is putting itself back together in a way that deserves close attention. The question is not whether Clorox survived. Clearly it did. The question is whether the margin recovery and brand resilience that are showing up in these numbers reflect a durable return to form, or a temporary bounce before private label and commodity costs reassert themselves.
Clorox Company, ticker CLX, is a leading consumer staples company headquartered in Oakland, California. The company's portfolio spans household cleaning, health and wellness, lifestyle, and international segments. The brand architecture is one of the strongest in its category. Clorox bleach and disinfectants are the category-defining products in household cleaning. Pine Sol handles multi-surface cleaning. Glad covers trash bags and food storage. Burt's Bees is a natural personal care brand with a loyal following. Hidden Valley dominates the ranch dressing category. Kingsford leads charcoal grilling. These are not generic commodity brands. They are entrenched category leaders with decades of consumer loyalty and significant retailer shelf space advantages. The market capitalization sits at approximately $10.5 billion. Revenue is roughly $7 billion on a trailing annual basis. Clorox sells its products in more than 100 countries, though the United States represents the large majority of revenue.
The Q1 2026 results represent meaningful evidence that the cyber attack recovery is real and sustained. EPS of $1.64 came in 9 cents above the consensus estimate of $1.55, a 6% beat. Revenue of $1,669 million reflects normalized order flow, returning to the business following the operational disruption of fiscal 2024. To contextualize what was lost, during the cyber attack recovery period in fiscal 2024, Clorox experienced quarterly revenue declines of roughly 25 to 30% as it was unable to fulfill retailer orders. The business that is reporting today is one that has rebuilt its manufacturing and supply chain operations, restocked retailer shelves, and is recapturing the consumer loyalty that its brands earned over decades. The beat on both EPS and the revenue trajectory signals that operational normalization is tracking ahead of what the street modeled.
Walking through the income statement, Clorox's margin recovery is the central narrative. Gross margins were severely compressed during and immediately after the cyber attack. The company had to absorb extraordinary costs associated with manual order processing, emergency logistics, and accelerated technology remediation while simultaneously undershipping revenue. The normalization of those costs, combined with Clorox's pricing actions taken across its portfolio, has driven meaningful gross margin recovery. The company has historically operated with gross margins in the range of 40 to 44%, and the trajectory back toward those levels is a critical indicator of business health. SG&A discipline is also important. Clorox has been managing costs carefully through the recovery while simultaneously investing in brand support and marketing to defend shelf space against private label encroachment. Operating leverage on the incremental revenue recovery is a key driver of the EPS beat versus expectations.
The signature deep dive for Clorox is the brand resilience question. Consumer staples brand loyalty is tested most severely precisely when supply is disrupted, and the August 2023 cyber attack was about as severe a supply disruption as a CPG company can experience while remaining operational. The critical insight from the recovery data is that Clorox did not permanently lose its shelf position to the degree some feared. Retailers gave the company time to recover because the alternative, permanently shifting to private label or secondary brands in the disinfecting cleaning category, carries its own risks and costs. Consumer loyalty to Clorox bleach in particular is deep and habitual in a way that is unusual even within consumer staples. Clorox has data suggesting that consumers who encountered out-of-stock situations during the disruption period were more likely to delay purchase than to permanently switch brands. That behavior validates the moat of its core brand franchise in a way that no normal quarter could.
On cash flow and the balance sheet, Clorox emerged from the cyber attack recovery with higher debt levels than pre-attack, reflecting the significant capital deployed on technology remediation, manufacturing recovery, and working capital rebuilding. The company has been diligently reducing that elevated leverage as free cash flow has normalized. Clorox has historically been a reliable free cash flow generator. Its asset-light manufacturing model and strong brand pricing power create a business that converts earnings to cash at a high rate. The priority now is restoring the balance sheet to a position consistent with investment-grade credit metrics while maintaining the dividend program that is an important part of the investor proposition. Capital expenditures remain focused on core operations and the technology infrastructure rebuild that the cyber attack necessitated. Management has indicated a return to a more normalized capital allocation framework as the extraordinary post-attack spending cycle winds down through fiscal 2026.
Capital returns are a meaningful element of the Clorox investment thesis. The company pays an annual dividend of approximately $4.76 per share, representing a yield of roughly 3.2% at the current price of around $150. Clorox has a long history as a dividend growth stock. It is a dividend aristocrat, with decades of consecutive annual dividend increases. The cyber attack disrupted many things at Clorox, but management protected the dividend throughout the recovery period, which was a strong signal of confidence in the medium-term earnings normalization trajectory. Share buybacks have been minimal during the recovery period as the company prioritized debt reduction and dividend sustainability. As the balance sheet strengthens through 2026 and 2027, the expectation is that buybacks will resume as a supplemental capital return mechanism, adding optionality to the shareholder return equation.
Management commentary coming out of Q1 highlighted several themes that frame the outlook. First, executives described the operational recovery as substantially complete. Manufacturing systems, distribution, and retailer relationships have all returned to normalized functionality. Second, management emphasized the resilience of Clorox brand equity through the disruption, noting that market share in key categories has recovered to levels consistent with pre-attack positions. Third, pricing actions taken during fiscal 2025 have been maintained, with limited evidence of consumer resistance at current price points, a positive signal for near-term margin sustainability. Fourth, management acknowledged the intensifying private label competitive environment, particularly in trash bags and some food storage products, and outlined plans for innovation and value communication to defend Glad's category position. Finally, the international segment remains a smaller but growing contributor as the company rebuilds its global go-to-market capabilities.
The analyst community is fairly cautious on Clorox despite the recovery progress. The consensus rating is hold, and the 12-month price target sits at approximately $162, about 8% above the current price of $150. Analysts acknowledge that the Q1 beat represents progress, and most have modeled continued earnings recovery through fiscal 2026. However, the cautious consensus reflects several concerns. The valuation is not cheap for a slow-growing consumer staples company. Organic volume growth has been modest, even as revenues recovered, and the private label threat in categories like trash bags is real and secular rather than cyclical. Several analysts have flagged that Clorox's premium valuation relative to consumer staples peers requires continued execution on the margin recovery and some evidence of volume growth above category rates. Conditions that the Q1 results partially meet but do not definitively establish.
On valuation, Clorox at $150 trades at a price-to-earnings multiple in the mid-20s on a forward basis, which is a premium to slower-growing consumer staples peers, but within the historical range for a high-quality brand portfolio with consistent free cash flow. The enterprise value to EBITDA multiple similarly reflects a quality premium embedded in the stock. The consensus price target of $162 implies 8% upside from current levels, which combined with the 3.2% dividend yield produces a potential total return in the 10 to 12% range over the next year. Acceptable, but not compelling unless earnings exceed current forecasts. The valuation story gets more interesting if Clorox can demonstrate organic volume growth above the flat to slightly positive levels embedded in consensus, or if commodity cost deflation provides upside to gross margin assumptions. Neither scenario is guaranteed, but both are plausible given the current environment.
Bull case number 1. The cyber attack created an artificially depressed earnings baseline that makes the recovery look like genuine growth even if underlying demand is stable. As fiscal 2024's losses fall out of the trailing 12-month calculations, and normalized fiscal 2026 earnings establish themselves as the run rate, the market may re-rate the stock toward a higher base. Additionally, if management can demonstrate that the technology investments made during the remediation period have actually improved Clorox's operational resilience, supply chain visibility, and customer service capabilities relative to the pre-attack baseline, the disaster could paradoxically leave Clorox in a stronger competitive position than before. A company that has stress-tested its systems under extreme conditions and rebuilt them with modern architecture may be better positioned operationally than one that was still running legacy infrastructure. That is a contrarian but defensible argument.
Bull case number 2 is the pricing power and margin recovery trajectory. Clorox operates in categories: household cleaning, disinfecting products, trash bags, where consumers have demonstrated consistent willingness to pay a premium for trusted branded products. The pricing actions Clorox implemented during the recovery period have been largely maintained without meaningful volume loss, which validates the brand equity thesis. If commodity costs, resins, surfactants, paper, and other key inputs deflate from current levels, Clorox is positioned to capture significant gross margin expansion without passing those savings through to consumers in lower retail prices. Consumer staples companies that take price during inflation and then benefit from cost tailwinds during deflation can produce exceptional earnings beats. The combination of a normalized cost structure, sustained pricing, and potential input cost tailwinds could drive EPS meaningfully above current consensus over the next 4 to 6 quarters.
Bull case number 3 is the health and wellness category tailwind that Clorox is uniquely positioned to capture. Post-pandemic consumer behavior has permanently elevated household spending on cleaning and disinfecting products relative to pre-pandemic baselines. Consumers who lived through COVID-19 are now consistently more conscious of surface hygiene and household cleanliness than prior generations. Clorox is the category leader in disinfecting products. Its bleach and Clorox disinfecting wipes have household penetration and brand recognition that is essentially unmatched. As that heightened hygiene consciousness settles into permanent consumer behavior rather than acute crisis response, Clorox's addressable market for its core products is structurally larger than it was in 2019. That does not guarantee growth, but it establishes a more favorable baseline from which the brand's innovation pipeline, including refillable products, concentrated formats, and new application areas, can build.
Bear case number 1 is private label competition. The household cleaning category has seen meaningful expansion of private label and store brand alternatives in recent years, driven by consumer value-seeking behavior in an inflationary environment and retailer margin pressure. Glad trash bags in particular face intense competition from retailer-owned brands that have improved quality substantially. Pine-Sol's multi-surface segment is contested by store brands at price points meaningfully below the branded product. If private label penetration accelerates, driven by either consumer price sensitivity or retailer promotional support, Clorox faces a scenario where it must choose between defending market share with price investment that compresses margins or defending margins while accepting share losses. Neither outcome supports the premium valuation the stock currently commands. The private label threat is structural in consumer staples and will not resolve based on Clorox's operational recovery alone.
Bear case number 2 is commodity cost inflation and slow organic growth. Clorox's gross margin recovery is partially dependent on input cost stability. Key commodities, resins for Glad products, surfactants for cleaning products, paper and fiber materials, are subject to significant price volatility tied to global supply chains and energy costs. If commodity costs reinflate from current levels, Clorox faces the challenge of either absorbing the margin hit or implementing further price increases in a consumer environment that is already showing some sensitivity to branded product premiums. Simultaneously, organic volume growth, distinct from the recovery-driven revenue normalization, has been modest. A consumer staples company trading at a premium multiple needs to demonstrate that it can grow volumes above category rates, and Clorox has not yet established that it can do so sustainably post-recovery. Slow organic growth combined with commodity pressure is a scenario that could see the stock re-rate downward from current levels.
Clorox is a brand portfolio that survived a catastrophic operational disruption and is demonstrating through Q1 2026 results that its core business is intact and recovering on schedule. The 6% EPS beat, the normalized revenue trajectory, and management's confident commentary collectively make a case for continued margin recovery through fiscal 2026. The primary risks, private label competition, commodity cost volatility, and a valuation that prices in significant recovery without a large margin of safety, are real constraints on the upside case. For investors who want exposure to durable household brands with a 3% income yield, Clorox offers a reasonable, if not exciting, risk-reward at current prices. The recovery thesis is largely playing out as hoped, and the question now is whether Clorox can transition from recovery mode into genuine organic growth mode, a harder and more consequential test of the brand's long-term competitive position. Financial data sourced from Financial Modeling Prep. Charged alpha is for educational purposes only and does not constitute investment advice. Always consult a qualified financial advisor before making investment decisions.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.